Hello everyone, this is Professor Kent. Today we are going to take up the homework for chapter 21. I'm going to do one exercise and I'm going to do one problem. The exercise that we're going to do is exercise 21 point 25. So the exercise that we're going to take up is 21.25. This exercise is a change in estimate. If it's change in estimate, we needed to treat it as prospectively. So let's see what the question is asking us, and then before even I can do anything, if it's a change in estimate, we do not need to do any entry for the prior years. If the entry no entry is necessary, changes in estimate are treated prospectively. So if even though before reading the question, and if I know it's a change in estimate, if it's a the question is change in estimate, no prior entry is needed. So no entry is necessary. No entry is necessary. And we need to make the change, and the change will be done prospectively. So the change will be done prospectively. So let's T-L-E-L-Y, prospectively. They're saying that Peter M. Dell Company purchased equipment. So what we did is the purchase, that's the cost of the equipment, is 510,000. That's what is given to us, which was estimated to have a useful life of 10 years with a residual life of 10 years, $10,000. So and the depreciation has been entered for the 7 years. So what we did is we have taken a depreciation for the 7 years, and they use a straight line depreciation. So straight line depreciation is 510,000 minus the 10 divided by the 10, and that will give me 50,000 per year depreciation. So depreciation is 50,000 per year, but they told us in the question 7 years is gone by. So 7 years has gone by. That means that we have taken some depreciation. The depreciation we have taken so far is 350,000. Now something else is happening in 2020. So we want to know what is happening. In 2020, it is determined the total estimated life should be 15. So life was 15, the total life should have been 15. So what we have to do is we have to recalculate our depreciation expense. We have to recalculate our depreciation expense. Again, the cost of the asset is not going to change, so that stays the same. But now what they told us that it is determined that the total estimated life should be 15 years. So instead of 10, the life should have been 15. There's a two way of doing it. I will show you, but you'll get the same answer. It doesn't matter which way you do it. Now we know that we already 7 years has gone by. So this is 350,000. That's the accumulated depreciation on the asset that is already gone. And then they said the new residual value is 5,000 instead of 10,000. So we make that a 5. So now what we did is we minus the accumulated depreciation. If that becomes our total life, we have to minus the years that are gone by. So in this case, if we have to minus it, the bottom number will be 8, and your top number will be 155,000. So our new depreciation per year will be $19,375. So what we needed to do is in other words, if it's a change in estimate, we do it prospectively. No adjusting entry is required for the previous year. My current year's depreciation that I have to do an entry for year 2020 will be depreciation expense and accumulated depreciation for the 19,375. Now I'm going to change ink and show you how to do another way of calculating this 8. There's another way of calculating this The other way to calculate 8 is the original life was 10 years. They increase the life by 5 to make it that the life is 15 minus the 7, and that is your that's how we got the 8. So it doesn't matter which way you get it, that's how you'll get the same answer. The next question that we had to do was the 21.5, and it is a problem. It's a problem, and in the problem there's more than one correcting entries by the look of it. So what the question is asking: prepare the necessary journal entry at December 31st 2020 to record the above transaction and changes in as appropriate. The books are still open. If the books are still open, and they told us the company's income tax rate, we are with the 25%. So we needed to account for the income tax. If we have to account for the income tax, we needed to adjust for the income tax. So let's do each one, and then what we'll do is we will see what entry we needed to do. So for each one, so we are going to prepare the journal entry. So the first one, we're looking at problem 21, and the first entry is this is the name of the company, Nedu Company, a small company following ASPE is adjusted and corrected its books at the end of the 2020. In reviewing its record, it complies the following information. Means this is the following information that is available to us. If that's the information that is available to us, they're saying that Nedu has failed to accrue sales commission payable at the end of the last 2 years. So what we did is we did not record an accrued entry. So if you have to record an entry, so in other words, what they're saying is we did not record 2020, we did not record 2019. So if there was something that we did not record for the previous year, and then if we did not, so think about it, it was for the sales commission. So sales commission is an expense in this case. Is an expense. If we did not record this expense in 2019, the impact on my net income, the impact on my retained earning. So if we did not record the expense, our net income was over. If my net income was over, my retained earning was also over. So what amount we did not record? The amount we did not record was $6,200. So the $6,200 was the sales commission that we did not record. So what we're going to do is we needed to that if the retained earning was over, how do we fix that retained earning? By debiting it. How much retained earnings? So then what do we do? In this case, we have the adjustment for the expense was $6,200. Since they told us we need to deal with income tax, then we have to do 1 minus the tax rate, and that will be the amount adjusted for your retained earning, and that will be my debit. Now they did not record this expense and a payable. So what we needed to do is we needed to record a salaries payable. So salaries payable will be a credit, that will be my accrued. In this case, it will be $3,800. Now how do we record the accrued payable? Debit will be an expense and credit will be a payable. Now in other words, we had to adjust for $6,200 for the last year, and for this year the expense was $3,800. So in other words, I need to adjust for my salaries expense, and that salaries expense, in other words, there's two ways of looking at it. My salaries expense, I have to adjust for my last year's expense, which is your $6,200. I have to adjust for $6,200, and then I have to put it in the right amount for this year. So this one was the expense for 19 that I had to adjust. This will be the expense for 2020. This was for this year. So then the impact on your salaries expense is difference between the both. That will be your 2,400. So the difference between the both will be 2,400, and that we needed to credit it. So that'll be your adjusting entry for 2,400. Now if my income was over in 19, what we did, we pay more taxes to the government. So if we paid more taxes, we're going to be, since it's going to be previous year, we're going to be receiving money from the government. So it will be, in this case, it is an income tax receivable. It's not a deferred tax because it does not relate to any reversing difference. So it's not related to the reversing difference, so then it is not a deferred tax asset. So it's a receivable. And what will be the receivable? That will be the $6,200 multiplied by the 25%, and that will be your 550, 1,550. So that's the first transaction that we had to do. So now we're going to go to our second transaction. So let's do our second transaction. Now this is relates to the inventory. So the second entry is relates to the inventory. Of course, 1 year's inventory gets adjusted in the next year. So 2018 it's 2 years has gone by, so it's automatically fixed by itself. In a reviewing the December 31st, 2020 inventory, NEDU discovered errors in its inventory taking procedures that have caused inventory for the past 3 years to be incorrect. So we know that this we fixed it by itself, so we don't need to adjust it. Now ending of one becomes the beginning of next year, ending of this becomes the beginning of the following year. So in other words, we have to adjust for the beginning inventory and we have to adjust for the ending inventory in year 2020. So that's what we are going to do. So now if I were to show you this, if you think about it, why did not we do anything in 18, 19 and 20? So why did I say that we ignore the 2021? Because at the end of the day, we don't need to do an adjusting entry for that. So now what we have is we have two type of inventory. We have a beginning inventory and we have an ending inventory. So in the first part, they said that the ending inventory was understated. If it was understated, means that we should have deducted more amount. So that's my ending inventory. If that was the adjustment, what I had to do is, if this was under, this was also under, that means I had to add the 21,000. Now the ending inventory in 2019 is understated. So what we had to do is we had to adjust the 24,000 here. We had to take it. So the overall adjustment will be for the 3,000 here. But then I'm just showing you what the impact is. The impact is that now then going forward, in this case I have to add the 24,000 here. In this case the ending inventory was over. That's maybe we took out too much. If we took out too much, we needed to add back the 9,000. If we had to add back the 9,000, the adjustment to our cost of goods sold, this is the, in other words, this is the adjustment. What is the adjustment? It's an adjustment to my cost of goods sold. So because cost of goods sold has both beginning inventory and ending inventory, if we're making an adjustment to cost of goods sold, that means that I needed to increase my cost of goods sold. Cost of goods sold is treated like it's an expense. So if I have to increase it, I'm gonna, what my entry will be, debit my cost of goods sold. So that will be my debit, and that is 33,000. So that's your cost of goods sold. Now we know that if we did not, so this, if you look at it, this cancels each other out. So now my other adjustment that I have to do is for the $24,000. So if the 24,000 is the ending inventory, it impacts your ending inventory, impacts your cost of goods sold. If the cost of goods sold are impacted, my net income was under. If my net income was under, my retained earning was also under. If they both were under, I need to adjust for that. If retained earning was under, how do I fix it? By crediting the retained earning. So how do I do that? By the retained earning adjustment was for 24,000, but since there's a tax, So 1 minus the tax rate, that's the adjustment to my retained earning. In this case it was 18,000. If my net income was under, that means we paid less taxes to the government, the less taxes to the CRA. If we pay less taxes, it will be called an income tax payable that we have to make a payment to the government. In this case, the adjustment was for 24,000, and what I have to do is multiply by the 25%, and that's the adjustment I have to make, and that will be I don't have a calculator. I do have it, I just got it because I don't have the number on my head. So 24,000 times the 25%, and the amount that we have to adjust is for 6,000. Now we have to, now our entry doesn't balance. Of course our entry doesn't balance. Now what happens is that we needed to adjust what we needed to adjust, because our ending inventory was over. If that was over, my ending inventory was over. If that was over, my asset inventory was also over by $9,000. So if my asset inventory is also over, I have to adjust it by crediting the inventory. So inventory will be a credit of $9,000. So in this case it is a credit. It is a credit here, and it is a credit, our entries balance. So that will be your second entry. So let's go to our next one, which is going to be number 3. Actually it's not number 3, so they go together. So in this case this shouldn't be this goes together. So now let's do our next one. This one will be your number 3. So this will be number 3, and this will be number 4. So let's do number 3. So number 3 is asking something to do with change in estimate. If it's a change in estimate, then we know that there's no prior period adjustment is needed. You make the adjustment prospectively. So let's see what the question is asking us to do. So let's look at the question. They're saying Nadu changed the depreciation method on its office equipment from double declining to straight line. So they were using a double declining, but what they want to use now is a straight line. So they're using a straight line. The equipment had an original cost. So the cost of the equipment was 160,000 when it was purchased. When did we purchase it? January 1st, 2018. Where we are in 2020. So we are in 2020. So we know that where we are and where we're going. At the time, it is estimated the office equipment had an 8-year useful life and no residual value. So the cost was that, no residual value. The life was, in this case, they told us the life was 8 years. So 8 years. But what they did is they didn't use a straight line. What they did is they used the double declining method, and they told us that depreciation expense recorded prior to 2020 under the double declining was 70,000. So whatever method they did, what they did is they had an accumulated depreciation of 70,000. So we don't need to know how they calculated. They told us in the question that's what the accumulated depreciation was. Now, and then they say the 70,000, and they said that. So now, and this is the depreciation they have taken their current year's depreciation. In other words, their current year's depreciation using the double declining was your 22,500. They already did a journal entry, but we need to adjust this inventory. Adjust this ending this entry. So cost of, they want us to use a straight line method. Cost was 160,000, and then what we had to do was that the residual value was was 0. The life of the asset was 8 years. So they told us that the 2 years has gone by. So how do we know that? January 1st 2018 is gone by. So the from 18 to 18 is gone by, and then 19 is also gone by. So 1 year is gone by, 2 years are gone by. So 2 years are gone by. What are we doing? We're looking at the current year's depreciation. They already did an entry. We want to know if they did the right entry. If they did not do the right entry, how do we fix that entry? So out of the 8 years, 2 years are gone by, and then what does that do? And then we also have to, 2 years are gone by, we also have to take the depreciation they have taken over the they have taken with the using a residual using a double declining method. So if that's the case, what we're going to do here is we're going to calculate what my depreciation should be. In this case, the depreciation they should be recording in 2020 would have been 15,000, but what they did is they recorded a depreciation expense of 22,500. So what we needed to do is we need to do an adjustment for the difference. In this case, we're not recording the depreciation expense. What we're doing is we put in too much in the depreciation expense, we have to take it out. If we take it out, we have to credit the depreciation expense. So we have to credit the depreciation expense of 7,500 and then debit the accumulated depreciation for the same amount. So in this case 7,500. Soon as we post the entry, our depreciation will be 1,500, and that's what we needed. So your accumulated depreciation is your debit and your credit is your depreciation expense. So that was the entry for number 3. And number 4, we have to see what they want us to do for number 4. So let's read and see what the question is asking us to do for number 4. They're saying before 2020, Nedu accounted for its income for the long-term construction contract on a completed contract basis. So what we are doing is we're calculating our income using the completed contract method. So what we're doing is we're using completed contract method. Because it is unable to reliably measure the degree of completion or the estimated cost to complete early. So what they're doing is they want to change it because they can estimate something better. So if they're changing estimate better, I'm looking at it that we might not need to do any entry, but we needed to do further. Early in 2020, Nedu changed to, so what they were using a completed contract method. Now what they wanted to do is percentage of completion method. So they wanted to do a percentage of completion method. The change was the result of experience with the projects and improved the ability to estimate the cost to completion and therefore the percentage of completion. So they're using it so they can estimate the cost better. The completed contract will continue to be using it for tax purposes. Income for 2020 recorded using the percentage of completed method has the following information prior to year. So what they did is they already changed it in this was done in the early 20. So if it was done early beginning of the year, so there's no adjustment is needed. So if there's no adjustment is needed, no entry is needed and no entry is required. So they decided they're going to do this in the early 2020, and it is because they wanted to improve the ability to estimate the cost better. So they're doing it change in estimate. In this case, it's not a change in policy, it is change in estimate. If it's a change in estimate, no entry is required. So in this case, it is a change in estimate. So I'm going to do it here. It is a change in due to an estimate, change in due to an estimate. If that's the case, no adjusting entry is required. So no adjusting entry is required. So no adjusting entry is required. So those are the 2 questions I had to do. Thank you for your time. Thank you for listening to me. Please do make a comment if you like the video. Do send me a message, and if you have any other question, or if you do want me to record any other video, reply to the message, send me a message on the on a YouTube, so that I'm able to record the video for what you're looking for. Thank you for listening. Take care. Bye for now.